The income splitting strategy, which has been the cornerstone of many family trusts for many Australians, is effectively shut down or significantly crippled. And no distribution from a discretionary trust will ever be effectively taxed at less than 30%. The bucket company strategy is dead. This is a once-in-a-generation shift in the Australian tax landscape. The structures that worked for the last 50 years is not going to be the right one for the next 50 years. Hi everyone. Welcome back to another installment of the Investing for Doctors podcast. I'm your host, Dr. B. This is the next part of our series exploring the 2026 federal budget that Treasurer Jim Chalmers has handed down on the 12th of May, 2026. From the events since budget night, we've had a lot of discussion about the changes and has frankly got some people's blood boiling. Now, this episode is going to be focused on the changes to discretionary trusts, and this is the most substantial structural tax reform in decades. Now, let's start with some basics, because before we can talk about what's changing, you need to understand what a trust actually is. Now, a trust isn't a company. It isn't a bank account. It's not even a legal entity in the traditional sense. At its fundamental core, a trust is a relationship, a legal relationship where one person or one entity called the trustee holds assets on behalf of someone else called the beneficiaries. The trustee has legal ownership of those assets, but they do not own them for themselves. They manage them for the benefit of the beneficiaries. That separation between who legally holds the asset and who actually benefits from them is the whole foundation of how a trust works. Obviously, there are other things such as settlers, appointers, and other aspects of the trust, which we will not go into today. Now, think of it like this. Imagine if you had a trusted friend and you've given them a sum of money and say, hey, hold this money for my kids, invest it, grow it, and make sure they're looked after. Your friend doesn't own that money, but they control it. And essentially, that's what a trustee does. Now, a trust is just a legal, formal framework around this kind of arrangement. Now, there are many types of trusts, but for our purposes today, the two that matters the most are going to be fixed trusts and discretionary trusts, or what we call non-fixed trusts. And the difference between them is critical for this episode. Now, in a fixed trust, or often called a unit trust, each beneficiary has a defined locked-in entitlement. If you're entitled to 25% of the trust income, you get 25% every time, and no one can change that, not even the trustee. And the trustee has no power to redirect anything away from you or give someone else a bigger slice of the pie. Your interest is fixed, and hence the name fixed trust. Now, managed investment funds are a common example of a fixed trust. You put money in, you hold units, and your share of the return is proportional to how much units you hold within the pool. A discretionary trust or a non-fixed trust is the exact opposite. The trustee has complete flexibility or discretion to decide who gets what and how much each year. The beneficiaries don't actually have a guaranteed entitlement to anything. They're eligible to receive a distribution, and that is entirely up to the trustee to decide whether they do, when they do, and how much they do. One year, the trustee might direct all income to one family member, and the next year to another. And this flexibility is what made discretionary trusts or family trusts such a powerful tax planning tool in Australia. And it's precisely that flexibility that the government and Treasurer is now targeting. So let's quickly talk about the current system. As mentioned before, the trustee has flexibility to direct income to any beneficiary that they see fit. And this is often directed to the family member that is on the lowest tax rate in any given year. So for instance, if mom's on a high income and dad's not working, or there's an adult child at university who's barely earning anything, the trustee can direct more of the trust income to the lower earners. And overall, the family tax bill goes down. And that's the mechanism. And this concept is called income splitting. Now, Australia has had these structures around since, the 1970s, and they have grown enormously. So we went from 500,000 trusts in 2003 to over 1 million trusts by 2023, which is almost a doubling in 20 years. And the ATO estimates there's something like $3 trillion plus worth of assets sitting within trust structures in this country. That's an enormous pool of wealth. And for a long time, that's largely sheltered from the kind of taxes that ordinary wage earners like you and I face. The government is arguing that, and they've been pretty quite frankly, direct and upfront about this, is that it is not fair that someone earning a wage pays their full marginal rate, potentially up to 47 cents on the dollar, while a family running the same economic activity through a discretionary trust can reduce that effective rate significantly by spreading the income around and using the $18,200 no tax threshold for an individual. They want to, in other words, more closely align tax rates on income from discretionary trusts with rates paid by workers and families who earn a living wage. Now, what are they actually doing about it? And this is critical. So from the 1st of July, 2028, the trustee of a discretionary trust will be required to pay a flat rate of 30% on the trust's net taxable income. So a flat 30% tax at the trustee level rather than at the beneficiary level. Now, previously, if you didn't distribute any income, the trustee would have to pay at the maximum tax threshold of 47%. But this is now enforced at a flat rate of 30%. So it's not taxed at the beneficiary, it's taxed at the trustee. Now, what this means is that the trust itself has now become a tax-paying entity at the trustee level of a flat 30% tax rate. Now, it is not a complete double taxation situation for everyone because the beneficiaries who are individuals, and take note, individuals only, will receive a non-refundable credit for the tax that the trustee has already paid. So similarly, it's like giving someone a franking credit, but if they don't use that tax credit, they don't get that money back. So if you're a beneficiary on a 47% marginal rate, you'll receive the distribution and you'll get a tax credit for the 30% already paid, and then you have to top up the difference of 15% income tax and 2% medical levy to add up to 17%. So your total tax on the income is still 47%, but 30% was collected at the trust level and 17% comes from you directly. However, this is where it gets interesting if you're a beneficiary at a lower rate. Say you're a student or someone on, a very part-time income who sits at the 14% tax bracket. Now, I'm quoting 14% because this is going to be the lowest tax bracket in 2028 without the Medicare levy. So, the tax credit is non-refundable, meaning you get the credit up to your tax liability. But if the trust has already paid 30% and your effective rate is only 14%, you do not get the 16% difference back. It's gone, it's forever lost, and the government gets to keep that. And that is the point of the new system. The minimum floor has been set, and no distribution from a discretionary trust will ever be effectively taxed at less than 30%. Again, the income splitting strategy, which has been the cornerstone of many family trusts for many Australians, is effectively shut down or significantly crippled. So what is the actual maximum increase in tax burden? I'll break it down. All right, so this actually comes down to $9,748 when this comes into force in the 2028 tax year. So how do I get this number? Now just follow me for some maths. So from the 1st of July, 2028, the lowest bracket drops down to 14%. And this has already been passed in legislation. So this 14% sits at the income level of $18,200 to $45,000. Now, if you earn up to $45,000, you will pay a total of $3,752 of income tax. Now, obviously, you still get to pay the 2% Medicare levy on top of that, but we will exclude that for this discussion. So up until you hit the 30% at $45,000, that's the total amount of tax you paid, $3,752. The new tax of 30% on $45,000 will result in a tax bill of $13,500. And if you do some simple subtraction, the difference comes up to $9,748. Now, this is a huge sum compared to what you were previously paying. But remember, this is the worst case scenario where you distribute $45,000 to a zero income individual. And this is the maximum tax that this new change will inflict on an individual. So this is not all doom and gloom, as a family trust could still offer you a tax saving of up to $6,750 if you distribute it to this individual versus someone who is sitting at the highest tax bracket. All right. Previously, the same individual would have received a lot more tax saving under the same strategy, over $16,000 of tax saving But unfortunately, this has just been reduced to $6,750 now. Now, furthermore, it is not all lost again, because you can continue distributing to someone at 30% rather than keeping at someone who's at the 47 or 45% bracket. And that extra 15% advantage extends all the way up to $135,000 of income. So that's another $9,000 worth of distribution that you could distribute with a 15% tax advantage before they hit the next bracket. So that is another $13,500 worth of potential tax saving. Now, what does this mean? It means that the original strategy of finding individuals who are on, who will end up paying no income tax, that's gone because it's now 30%. However, this is just the tip of the iceberg, because now we're about to talk about something that I think is even bigger structural shock, and that is the treatment of corporate beneficiaries. And these beneficiaries are often called bucket companies because they act as a bucket to sync up the income that's generated by the trust. Now, the bucket company strategy has been widely used for many years. What it does is that instead of distributing all the trust income to an individual beneficiary and having it taxed at their personal rates, because sometimes, you know what, you might not have an individual that is sitting on a low tax bracket. For example, you know, if you have a professional couple who's both at 47% and you have young children, you have no one to distribute to. So what they do is that then they distribute this to a company, and the company pays the corporate tax rate, which is, you know, 30% for a passive investment company or 25% for base rate entities. Then you leave the money sitting in the company where you can only draw it out by dividends when it suits you, potentially in a lower income year or when you do eventually have someone to distribute to. So you don't pay 47%, you pay 30% or 25% at the company level. And then later on, you can transfer that out where you still get the franking credits, etc., etc. So under this new rule, you know, the bucket company strategy is dead, right? Corporate beneficiary, they do not receive that tax credit for the 30% tax paid at the trustee level. So zero. Okay. And the budget papers have made this very clear that this is intentional and is not an oversight, right? The concern is that if a company got the credit, it could then convert that into a franking credit and then pass the tax relief back through to shareholders via dividends. So it then circumvents the entire point of the minimum tax. However, it really depends on how you are holding your bucket company, because many people hold bucket companies via a trust structure. So when they distribute it out, they're going to get taxed anyway. But that is beyond the scope of discussion today. So what does this mean in real life practice? There is a risk of double taxation. You know, the trust pays 30%, the income flows to the corporate beneficiary, the company pays the corporate tax rate, again, either 25 or 30%, and they do not get a credit. Now, the company obviously still has a franking credit, but that tax paid at the trust level is then effectively lost, right? And that's the company's way of actually saying the bucket company strategy is over, all right? If you're currently using one, you might need to think about how you're structuring your assets. So who does all these new changes actually affect? And in short, basically everyone who operates a discretionary trust, right? Small business owners, farmers, tradies, who run their family business through their family trust, professional services like accountants, lawyers, doctors, and dentists who use trust to manage their practice, property investors who use trust structures, and families who have built up wealth, you know, over a period of time using these vehicles. Now, there have been many accountants that have been quite vocal about the concern that the restructuring out of these trusts won't be painless, and there are going to be lots and lots of transaction costs. There's also potential stamp duty implications at the state level. There are capital gains events that might be triggered. And there are just the practical complexities of reorganizing these affairs, updating bank accounts, loan agreements, insurance policy, and all of that takes time and money. All right. But thankfully, the government has put in place some help. And the main thing is that, firstly, this minimum tax kicks in on the 1st of July, 2028. And there will be consultation on the details of how all of this works, like how non-cash distribution are treated, you know, what happens to existing loan arrangements, and how collection mechanism actually works. These are not been sort of written down in detail or passed through legislation yet. And obviously, because the legislation isn't drafted, we do not know how the finer details of these changes will work. But the policy intention is crystal clear that the government wants to effectively shut down these tax loopholes. Now, one last point on discretionary trusts before we move on. And there's a definite uncertainty buried in all of this. And I think that the legal and accounting community is going to be wrestling with this for some time. The actual term discretionary trust doesn't actually have a settled definition in the income tax legislation. All right. The rules that apply to tax are what are not considered fixed in nature. So actually, a discretionary trust is not a name itself. It is just everything used to describe a trust that is not fixed. And hence we started our discussion about fixed and non-fixed trust. And sometimes the line between a fixed and a non-fixed trust is quite blurry. And many trustees that were drafted to operate at fixed trust contain variation powers or default clauses that might actually cause them to fail this what we call non-fixed test. And what this means, we need to see this when the legislation actually comes out. And what this also means is that some trustees may not actually be aware of what category their trust falls in, and they may need to get legal advice or potentially ATO rulings to find out. And I think that's actually a real issue that no one has taken seriously just yet. All right, so enough about trusts. Family trusts. Let's move on to the next topic, which is testamentary trusts. All right, this is important because this is a slightly different story and has slightly different rules applied to this. And there are some nuances that I think a lot of people would have missed. All right, so first of all, a testamentary trust is a trust established through a will, and they are most often discretionary in nature, so they're non-fixed. And the new changes to discretionary trust will affect testamentary trust. However, the government has some carve-out provisions for that. So in a testamentary trust, what it does is instead of leaving assets directly to your kids or other beneficiaries, your will creates this trust, and those assets are held within the trust after you die. The trustee, which is called the executor, often the executor or another family member, then manages the assets and distributes income to beneficiaries according to their need or as previously defined in the will. Now, testamentary trusts have traditionally had some additional tax concessions attached to them, particularly around distribution to minor beneficiaries. So under the current ATO rules, children receiving income from a testamentary trust are taxed at the adult marginal rates, rather than the punitive rates that apply to children receiving unearned income through other sources. So that's been a significant benefit and a big reason why estate planning professionals have always recommended testamentary trusts for family with young children or dependents. So how does the new minimum tax treat testamentary trusts? So the government has actually provided some special provisions or partial carve-outs. All right. So income from assets held in discretionary testamentary trusts that were already in existence before budget night, or the 12th of May 2026, is excluded from the minimum trust. So all of these testamentary trusts have been grandfathered, and are not affected by the new system. So if you already have a testamentary trust that's been set up and running, which means that the person who's made the will has already passed on, the trust is already established, then you are protected. The income will be continued taxed the way it had always been. But there is a critical trap. All right, I call this a bit of a trap because you need to be aware of this. The carve-out is not trust specific, it is asset specific. So what that means is that even if the trust existed before budget night, any new assets within the trust or contributed within that trust after the 12th of May 2026 will not be protected, and those will be subject to the minimum tax. So just looking at this is going to be an accounting nightmare because you got to basically say when you've acquired this, when you've started acquiring the asset, and then start the two different taxation systems. And that's just an utter mess in my honest belief. So now there is also this other second trap that I think more people are aware about, is that testamentary trusts that are established after budget night. So even if the will was written, years ago, and the person hasn't passed away yet, so technically the trust doesn't legally exist, those trusts will fall under the new rules. So what does this mean for estate planning? If you have an existing will that includes a testamentary trust clause, but you're still alive and the trust doesn't actually exist, when you pass away and the trust is established, it will be established after budget night. It won't be grandfathered and it won't be protected, and it will fall in under the new system. So this is a wake-up call for anyone who is in the middle of estate planning or thinking about estate planning. Your wills will need to be reviewed. Your estate planner and accountant need to be talking to each other about this. The structure you had in mind, or the one that, for instance, your parents might have set up years ago, may now work very differently from what it was intended. So for people who already have a testamentary trust running, say, you're the surviving spouse managing a trust for children following a partner's death, you're largely protected from these new taxes for the existing assets. But now you need to be careful about what goes in from here on now, because every new asset contributed after the 12th of May will not have the same protection. So for instance, if you sold some shares under the old system and then purchased new shares, they will not be protected. All right. So the government hasn't been terribly generous with this carve out, but I guess some commentator pointed out that this part of the change has also received a lot less attention than the minimum tax threshold, even though it has significant implications for a lot of families who have done estate planning in good faith, and they will end up being hit. And this is especially true for those whose testamentary trusts have not been established yet, but they've gone through all the legal paperwork. So this is a wake-up call. Every one of those needs to be reviewed to make sure you're not caught out in this. One more thing that is perhaps worth noting is that the tax concession for minor beneficiaries within testamentary trust are not directly mentioned as being removed. So hopefully these will stay, and the minor beneficiaries will not be taxed at the punitive rates. So I think once the legislation, the draft legislation comes out, we need to be really carefully looking at how all of these things interact with one another to see what the new rules are. And obviously, everything we're talking about today is still very speculative in nature because the legislation has not been drafted and obviously it has not been passed. But the bottom line on testamentary trust is, if you've got one already running, you're broadly protected on existing assets, but watch out for what you add into it. And if your will includes a testamentary trust that hasn't been activated yet, you need to get legal advice now, because the trust that it creates could be very well subjected to the new minimum tax in full force. So now let's talk about capital gains tax. We've covered this in a previous episode, but I think it needs to be rediscussed in the context of the taxes within trusts. Because the trust changes don't exist in isolation, and we really need to look at both of these things together. So at the current moment, if you hold an asset for more than 12 months and sell it, you get what we call the 50% capital gains tax discount before it is added to your taxable income. So if you made a $200,000 capital gains on a property, you only end up paying $100,000 of tax on it. And this discount has been sort of one of the most powerful wealth building mechanisms in Australia since it was introduced in 1999. It applies to individuals, trusts, and also partnerships. But unfortunately, as of the 1st of July 2027, that's all changed. All right, this 50% capital gains tax discount is being replaced by two things, and which operates together. The first one is what we call the return of cost-based indexation, which is how capital gains were taxed between 1985, when it was first introduced, until 1999, when we swapped to the capital gains tax discount system. So under indexation, you basically adjust the base cost of your asset for inflation using the CPI, or the Consumer Price Index, which is a mark of inflation. So what this means is that you only pay tax on the real gains above inflation. And that's actually quite a sensible concept, because you don't want to tax people on nominal gains or the absolute gains, and you don't want to tax people on inflation. Now, the second change is that 30% minimum tax rate on capital gains. So even with indexation and you have real gains, the minimum tax you pay on it is 30%. So this is very similar concept to the trust. You have a minimum 30% tax no matter where you go. All right. So now for a trust, this 30%, they do not double up to become 30 plus 30 because of 60%. It stacks on top of each other. So it just creates a 30% floor, and you're not going to be taxed twice because the tax credit will then flow through and cancel out the capital gains tax. All right. Hopefully that makes sense. But the long and short of it is that no matter which way you go, if it's capital gains distributed through trust, you're going to be taxed at the floor of 30% regardless. So now what we have is effectively a floor on any form of distribution, and that includes capital gains distribution. And the tax efficient sale of an asset like an investment property or share portfolio through a discretionary trust, where the gain was distributed to the lower income beneficiary and then taxed at a marginal rate, and then benefiting from the 50% discount via income splitting, that strategy is completely over now. So it doesn't exist in isolation. All right. So here's what I actually think the most important thing to understand about the combined effect of the two on trust planning. All right. So we've basically had a 50-year or so period in Australia where discretionary trusts were the vehicle of choice for private wealth. Precisely because they combine income splitting, flexibility of distribution, and capital gains discount access. Because as you know, companies don't get access to the capital gains tax discount, but when you distribute capital gains through a trust to the individual, or the individual gets access to those capital gains tax discount. Those two benefits reinforced each other. And the trust gave you flexibility on who was taxed, where the capital gains discount went to, and we've now fundamentally removed both. And the economic case for running a family trust for wealth creation is probably reduced. All right, and it doesn't mean it's worthless, but it is no longer as good as it used to be. Okay, so there are obviously still legitimate reasons to use family trust, and they can still be used as income splitting tool to reduce your overall family income. But now this is largely reserved for people who are going from 47% tax bracket to 30%. So the marginal gains are a lot lower, and it's a maximum of 15% saving. But obviously, other reasons such as asset protection, estate planning flexibility, managing assets for minors, and structuring investment across family groups, as well as a certain sort of businesses, might still be sensible to use discretionary trust. But the purely tax-driven reason to use a discretionary trust, that calculus has changed significantly, and its effectiveness is a lot more reduced. Now, I want to flag something that many experts have sort of noted and flagged, but has not received as much public attention. All right. So the budget papers were largely silent on how this minimum tax will interact with non-cash distribution. So what does this mean? In the real world, the tax, the trusts don't always distribute cash to the individual. It sort of just assigns those rights. And they distribute what we call the entitlements, so which is a right to trust property, or a paper allocation that might sit as a what we call an unpaid present entitlement, and the money actually is then loaned back into trust or put back into trust. Okay, so the question then is, how is the trustee supposed to pay the 30% minimum tax if no actual cash has changed hands? Or this becomes a little bit more confusing, because previously the tax liabilities were passed down to the individual, and the individual pays tax. So the question of whether then the individual then has to pay tax back up into the trust for the trustee to pay these taxes, we don't know exactly how that's going to work. And I think that's a design question that has to be resolved at consultation, and I don't think this is a trivial question. All right, and the thing is that we're looking at billions of dollars of unpaid present entitlements currently sitting in trust structures across the country, and every year that number will go up with new distributions happening. Okay, and so the interaction with the new rules and how this mechanism will work is still unclear at this stage. Okay, so I think that's probably the scarier thing that hasn't attracted a lot of attention so far. Okay, so we've covered some pretty confronting changes for those who have a family trust or invest through a family trust. So my question, your question probably is, if you're running a discretionary trust, what can you actually do to mitigate all these changes? So I think there is some good news to this, and I think it is generally meaningful, is that the government has put in place a set of provisions designed to give people an opportunity to transition into other structures. Okay, and it's not everything everyone's hoped for, but I think there is a genuine window that the government has given. And so let's talk a bit more about this and what's been announced. So the government has technically announced what we call the expanded rollover relief. Okay, so from the 1st of July 2027, the government is providing this relief period of 3 years, which closes on the 30th of June 2030. Okay, now this rollover allows businesses and individuals to restructure out of a discretionary trust into another entity type. And it is my belief that the recommendation from tax advisors and accountants is that it is going to be either into a company or converting a discretionary trust into a fixed trust. And when this is done, this will not trigger the usual tax consequences that will normally apply to such a restructure. So what does this mean in practice? So when you move assets from one entity to another, you normally have to this process is called what we call a deemed disposal. All right, and it can actually trigger capital gains tax. Even though no money has changed hands, it will trigger stamp duty, and there will be a lot of income tax consequences on that. All right, so this rollover relief is designed to defer those consequences. Okay, so you're not eliminating the tax liability, but you are rolling it from one to another. And so you can restructure it during this 3-year window without being hit with a massive upfront tax bill. Okay, so the detailed design of this rollover is still being developed through consultation, and the government said will provide relief from income tax consequences, including capital gains tax. All right, so that's clear. But the interaction with state-based taxation systems such as stamp duty, which is administered by state governments and not the federal government, is a lot less clear. And I think that's going to vary state by state, and that can be another big point of contention as the rollover relief is happening, especially for properties, because as you know, stamp duty for property is not a small sum, and how this will interact is a question that remains to be answered. So anyone who's considering restructuring will definitely need to get stamp duty advice based on their local state and jurisdiction. All right, now 3 years might sound like a bit of time, but I think that may not be long enough. And here's why. So firstly, the legislation of how all of these things are going to happen has not been written yet. Okay, and the government is sort of committed to consultation on the design of this. So that means there's going to be a consultation period before the draft legislation is released. And when that is finalized, it still needs to be signed into legislation. So, advisors, accountants, they can't really give advice being fully confident that that's exactly how it will work. And, this process can take anything from 6 months, 12 months, to goodness knows how long. Okay. And secondly, the restructuring out of a trust is not a simple process. You need valuations done. You need to know what the assets are worth. And this is very tricky for non-publicly held assets or shares in a business or company because the valuation can often be very intangible or difficult to value. Now, obviously, if property involved, you need the banker or the financier consent. The bank has to agree to a transfer mortgage. There may be additional paperwork. There may be additional accounting work that needs to be done. If you're restructuring to a company, you need to have ASIC registration for a new company. If you're going to a different trustee, you might need a different trustee arrangement and the original trustee arrangement to be wound down. And all of that takes time, right? And the last thing is that in this 3 years, there's going to be a rush of people restructuring. We spoke about this. There's about 1 million discretionary trusts in operation in Australia. And so there's going to be a rush for advisors, lawyers, and accountants to figure out how all of this works. And they simply could be overstretched from a resourcing perspective. So I guess the message that you should take home from here is that don't wait until the last moment to think about this. Start thinking about it now. See what the draft legislation looks like and start planning towards what you want your future structuring to look like. I think that's going to be a topic for a future podcast, but it's probably beyond the discussion for today. Now, one of the last things I want to say is that the government has introduced some specific support to assist in the rollover. And from the 1st of Jan 2027, they've mentioned that the Australian Small Business and Ombudsman will have a dedicated role in helping small business understand their options under these new changes. So, as I mentioned earlier, this doesn't just affect family trust for wealth creation, also affects lots of businesses that are operating under discretionary trust structures. And they should be available to explain the pathways and help people understand what the restructuring process looks like and help provide guidance on the process. But, knowing what I know about running medical practices and dental practices, this could be an absolute mess because it not only involves employees, it also involves contractors and all the accounts, and everything needs to be reset up in a particular way. So this is going to be very complicated, and it's going to be an absolute boon for accountants, tax advisors, and legal professions leading up to this. Now, I guess what does all of this look like practically? And I think for many people operating through a trust, the decision to move or change is not black and white, and it's not simply going from trust is bad, company is good, and every structure has its own problems. But ultimately, a company gives you a flat tax rate of 25% for base rate entities and 30% for passive investment companies. And so, that roughly aligns with the new 30% minimum tax. So I believe that a lot of businesses operating on trust will probably end up becoming companies and operating under a private limited structure. The good thing about companies is that they can retain profits and distribute them as franked dividends when the timing suits for the shareholders. And the companies can be structured for all sorts of different other purposes like employee ownership, equity, and capital raising. Now, the other option that these businesses can move to is a fixed trust. And so one where the beneficiaries have fixed entitlements rather than discretionary ones. The fixed entitlement is very similar to how shares in a company structure works. And these fixed trusts won't be subjected to the new minimum tax. So for some families, restructuring into a fixed trust might preserve some of the flow-through value the flow-through characteristics they value, while moving their trust outside of the new discretionary tax, the discretionary trust tax regime. All right. So the thing is, obviously, trusts have served more than one purpose beyond tax minimization. And the biggest one is asset protection and keeping wealth within bloodlines and managing assets for family members with a disability. So for those people, the decision to restructure could actually be quite difficult. I think if you're in that situation, you should consult your accountant as well as potentially a financial advisor to figure out exactly what is the best way to restructure. So the key point, I want to leave the viewers here is that the restructuring provisions is there. The window is 3 years. The reliefs are actually meaningful, but it's a hard deadline. And, if you're not thinking about it today, start thinking about it. The rollover relief starts from the 1st of July, 2027 and closes on the 30th of June, 2030. All right. And, this is my firm belief, because given how long it takes for people to get proper advice, get all of these valuations done, execute the restructure, especially if property is involved, I think you need to start the conversation now in 2026 and make, plans for what the new structure will be come 1st of July, 2027. So I think that's all we're going to talk about today. So let's just try to summarize and bring this all together. The 2026 federal budget has probably delivered the most significant overhaul to trust taxation in Australian history. And while the government has framed it as closing a loophole for the wealthy, the reality is that discretionary trusts are used by ordinary small business owner and family investors across the country, including, I wager, a lot of those listening to this episode. Here's what I want you to walk away remembering. For discretionary family trust, from the 1st of July 2028, a flat 30% minimum tax applies at the trustee level. Non-corporate beneficiaries get a non-refundable credit. Corporate beneficiaries get nothing. So bucket company strategies have become unworkable or a lot less useful. The detailed design is being consulted on, but the policy intent is definite and clear. For testamentary trust, there's a partial carve-out for trusts that are already in operation and in existence before budget night, which is the 12th of May 2026, but new assets going into those trusts after that date, and any new trust established after that date will be caught up by the new rules. All existing estate plans need to be reviewed urgently. Now, for capital gains from the 1st of July 2027, the 50% discount is out and is replaced with indexation and a 30% minimum tax on real gains. All right, and this stacks with the minimum trust tax, and it creates a dual floor to capture sort of anything that goes through a trust. But the minimum rate is going to be 30%. And the thing is that you will not be double taxed on this. So the tax efficiency of holding growth assets in a discretionary trust and then distributing gains to lower rate beneficiaries is largely reduced. It is still there if you are sitting on 47% and distributing to someone at the 30% bracket, but the initial tax-free component and the ones at the lowest tax bracket were largely removed. Okay, so lastly, on a restructuring, there is going to be a rollover relief that lasts for 3 years, starting on the 1st of July 2027. And the government has given you 3 years to restructure out of a discretionary trust, either into a company or a fixed trust, and they will defer the tax consequences. Okay, government support will be available from the 1st of July 2027, to help people through this process. Obviously, the window is only 3 years, and it might seem like a lot of time, but it actually probably will go quite quickly based on how complex some of these trust structures are. Obviously, the design and the legislation is still being consulted on and needs to be finalized. So my strongest piece of advice, and I say this knowing that everyone's situation is different, and obviously none of this is personal advice, is that you need to get in front of your consultant, financial advisor, and estate planner as soon as possible. All of these things need to be sorted out ASAP, because you should not panic, but you need to understand your position, understand your future options, and give yourself enough time to make a good decision rather than a rushed one. All right, this is I would say this is a once in a generation shift in the Australian tax landscape. The structures that worked for the last 50 years is not going to be the right one for the next 50 years. The good news is that there's still time to make thoughtful transition. All right. Now, thank you for listening. And if you found this useful, share it with someone who runs a trust and is thinking about estate planning, because a lot of people are going to be needing to hear this. Until next time, Dr. B out. This podcast is for educational and entertainment purposes only.
The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.